Hey guys, it's Kyan. Listen, I've been investing in the Canadian dollar recently because the Bank of Canada is raising interest rates and Canada's key commodity export, oil, is very, very expensive right now in the market. It's at $120 a barrel. Now, interest rates are going up and that supports any currency in the markets, especially the Canadian dollar. But when you get interest rates going up alongside the key commodity going up in price of a country's exports, that is a double whammy that can support a currency to really appreciate in value in exchange rate. So I've been trading this currency against the Japanese yen because Japan has low interest rates, doesn't sell commodities, so they're less anchored to the sensitivity of interest rate changes like that we are seeing in Canada. So fundamentally, I've been buying the Canadian dollar against the Japanese yen. We're in a profit right now of my members, and I'm expecting this currency to continue to appreciate in value. So I want to break down this trade for you in more detail so you can really understand the fundamentals that drive currencies, and I hope this adds some value to your trading. So guys, look, watch the video, enjoy it, get in contact if you want to come trade alongside me, but understand currency pairs, commodity prices, and exchange rates. Welcome to today's live session. We're going to start now by talking about the Canadian dollar. So I just posted a short written description about what's being said about the Canadian economy. So I want to read to you why markets are now, and you can see that the Canadian dollar is pulling higher in the currency markets, and it's all to do with the market's expectations of the Bank of Canada to raise interest rates today. So let me read you through what the Bank of Canada is saying, and then we can look at some potential trade ideas with the Canadian dollar. So let's first of all let's have a look at the Canadian economy so we know what's happening. And if you look at the Canadian economy, we can see currently inflation is at 6.8%. We know that's very high. That's above the central bank's 2% target. We understand why inflation is so high, as I've been explaining to you in previous videos, because of high energy prices, high oil prices, higher natural gas prices, high food prices being driven by, number one, the COVID lockdowns are still being felt hard in the business sectors in terms of the supply chain. So you got China, which we know is the manufacturing company of the world. They're still in lockdown. They just come out of lockdown today in Shanghai, but there's still other places that are still in lockdown. As China manufactures a lot of the world's goods, they have been able to produce those goods fast enough from China and other Asian countries and ship them into the West to meet the massive demand and spending now that many of the Western countries have come out of lockdown. So that's driven up prices on the supply side. And then you have the war in Ukraine, which has pushed up energy prices. As I've been showing you guys with the oil markets, we can see oil is very, very bullish. As we can clearly see, $117 a barrel. You got natural gas causing energy prices in Europe to skyrocket. We can see natural gas prices this year alone have gone up 140%. They were up 180%. So people's energy bills are going higher. And then the war in Ukraine is causing food prices to go higher because Ukraine and Russia produce, I think, like 30% of the world's wheat and grains. So food prices are going up because Russia is blocking the export of this key commodities to the world. And now there's a food crisis. So you got inflation coming all around the world. This is causing prices to rise. So that explains why, not just in Canada, but in other countries like the United Kingdom, where inflation is at 9%. In the US, we know inflation is very high. Europe's inflation just peaked at 8.1%. So inflation is a problem all around the world. And in Canada, there's no difference. So as we know, central banks are raising interest rates. Canada's central bank has already been raising interest rates. You can see in February and in April, and now in June, they're going to raise rates today by up to around 1.5% from the current rate of 1%. So they're raising interest rates at 50 basis points, which is by 0.5%. That's very aggressive rate hikes currently being priced in by the Canadian central bank. Now, just remember, guys, this makes the Canadian dollar very, very attractive in the currency markets. Number one, if you buy government bonds in Canada off the government, you're getting paid 2.83% interest on a government bond. What is today's price since I last updated that spreadsheet? 2.93. It's gone up even more. Okay, so look, the bond market is meaning that if I borrow money to the Canadian government, over a 10-year period, and I buy a bond, I'm going to get paid 3% interest, basically. Now, that's attractive compared to countries like Japan, where, as I've been showing you guys, Japan's inflation is very low at 1.2%. Core inflation, when you strip out food and energy, is only at 0.8%. It's nowhere near their 2% target. So the central bank has no reason to raise interest rates, but they leave them extremely low to try to get inflation up to 2%. Japan's been struggling to get inflation to 2% for like 10 to 20 years. It's ridiculous because they have a problem with their inflationary environment. And if you look over the next 5 years, inflation is expected to remain very low. So you can see why, if you borrow money to the Japanese government, investors are not demanding a high interest rate because there's no inflation. So the interest rates are very low, and the central bank is capping the interest rate to remain low on 10-year government bonds to try to make spending easier for consumers in the economy. So like if mortgage rates are very low, which are tied to the 10-year bond yield, it means people can spend more money. Okay, so we can see Japan and Canada has a differential in interest rates. If you borrow money to the Canadian government over the Japanese government, you're getting paid a very, very handsome premium right now. And that's why, as I've been showing you guys on multiple occasions, when we look at the bond market, it really drives the currency markets. So again, if I take you over here, I take you to the currency spreadsheet, I take you over to government bond yields, and you can see just how strongly this is always driving the currency markets. And then I'm going to talk to you about oil because it's very important to the Canadian dollar as well. So let's look at Canada. Again, look, we can look at the Canadian 10-year government bond and we can minus the interest rate on the 10-year bond. And we can take the Japanese 10-year bond and we can minus the difference to basically see who's paying a premium. So on the left-hand side of this chart, anything above zero means Canada's paying a premium interest rate over Japan. So it's basically Canada's rate minus Japan's rate. Okay, and you can see again, when the difference is going lower, meaning that the Canadian government's no longer paying as much of a premium, the Japanese yen strengthens against the Canadian dollar. And as soon as the differential goes in favor of Canada and starts to increase, so investors get paid more money, you can see the Canadian dollar strengthens against the yen, and you can see they literally move with each other. And fundamentally, guys, it's just a really simple equation to understand. The more that Canada pays a higher interest rate over Japan, the more money that goes into Canada relative to Japan. And then exchange rate value is just when you can compare rest of world reserves of two different currencies as a ratio. So as more money comes into Canada, there's less reserves of Canadian dollars in the rest of the world compared to Japan, and that pushes up the exchange rate. And that's why right now, if this differential keeps going higher in Canada's favor, the exchange rate keeps moving to the upside. So we can even add the latest month here, March, April, and May. So if we go back to Canada's 10-year bond, and we can get the last 2 months of data, because I haven't updated this in a while, you can see exactly how I do this, which is really important for you to see for yourselves. So we can go over here, we can go to the monthly data. I'm just showing you guys how to create these charts, because it's really important you know how to do this, because you'll know how to anticipate currency moves. So look, the last 2 months, the May was at 2.9 and today's 2.94. So we can go in here and we can put 2.9, 2.94. Okay, so the Canadian interest rate is really starting to pick up and it's really starting to pay a strong premium over Japan. Let me make that to 2 decimal point places instead of 3. So we can see, guys, the interest rate differential is really moving in Canada's favor. So again, we can then now go and have a look at what the Japanese rate has been for the past 2 months. 0.23% is the current rate. If you look at in the last 2 months, we can get an exact reading of what the rates were. Go to the monthly chart. Okay, so 0.23, 0.23. So it hasn't changed for the past 2 months. And as I was saying, that's because the central bank is keeping rates low on purpose. So we can see that the differential has continued to climb. Now, Canada's paying a 2.71% premium over Japan. So we can get the exchange rate over the past 2 months. We can have a look at what the value's been. And you'll see when I update the spreadsheet how much it just plays into the currency moves continuously going in Canada's favor. So let me just close this open a bit, open this up. Okay, so the exchange rate's gone from, in January it was, so you can see how the exchange rate's been going up, 90.75, 90.69, 97.33, 100.96, 101.74. And now if we go back to the spreadsheet, we will see how this has updated. Look, so now you can really see how much this currency pair is moving in favor of the Canadian dollar. Let's change the time frame to the end of the year so we get more space on the chart. Look, guys, you can clearly see just how much that bond, the interest rate in bonds, is pushing up the currency markets. So I've already been buying the Canadian dollar against the Japanese yen with my investors and all my members. So this is the trade that we're already in, and we're already in a profit for this trade, which is great. And again, as this keeps trending higher, guys, I'm going to keep buying the Canadian dollar against the Japanese yen. That's a trade I'm not going to come out of for a while because, again, it's just pushing in favor of the Canadian dollar. And you can expect this trend to continue because the Canadian Central Bank is going to keep raising rates. So look, let's have a look at where rates are going in Canada so we can get an idea as to this trend. So let's go back. Let me just save this chart. Let's go back and have a look. We can see, again, look, rates are going up in Canada towards the end of the year. So that 1.5% today, and then 2% in July, 2.5% in September, 2.75% in December. Okay, and if you read this article, we can see the Bank of Canada is telling the markets they're going to keep raising rates. The Bank of Canada needs to remain aggressive and reassure the public that they will bring down inflation. So you can see the markets know what the central bank has to do in order to calm people's nerves about inflationary pressures. Because the reason they're doing this, guys, is the one thing you need to understand is this. If they don't start raising interest rates and the public believe that inflation will keep going higher, what the public start to do is they go into their work and they tell their boss, you have to pay me higher wages because I am losing my purchasing power of the currency to inflation. I need higher wages. And then businesses obviously don't want to lose their best employees. So they're going to raise wages and offer them better pay packages. But then what the businesses are then going to do is they're going to go and raise their prices on the shop floor to offset the cost of paying higher wages because they obviously have to keep their profit margin strong to keep investors happy and then hopefully keep the stock price of the company floating at a high value in the exchange rate. And that happening all around the economy at the same time with millions of businesses, imagine how much inflation starts to go up as prices go up even more. That's why as the unemployment rate gets really low and those people have a job, the wage growth starts to pick up because the central bank because consumers are demanding higher wages. Look, the latest reading was 4.3%. Look, you can see it's gone from 2.1 to 4.3. This is literally showing you guys that the inflation is causing wages to go up. And that's exactly what the central bank is trying to avoid. The central bank doesn't want that situation because they know the problem that can start to cause. That's why they're raising rates to keep people's expectations of inflation within their 2%. Well, a central bank has like a 1% to 3% band, and they're basically trying to keep their expectation within that 1% to 3% because then people won't start demanding higher wages, for an example, and they won't stop spending money because if they believe that they're not going to make money moving forward because they're losing money to inflation, they may cut back spending. All right. So another key thing to look out for Canada, we need to understand that the Canadian dollar is really driven by the price of oil. Now, the reason for this is because Canada's key export is oil, guys. Okay. And if you can understand that, and we know that the oil price is bullish right now, then we know that if oil prices remain high, it's going to support the Canadian dollar to strengthen as well in the currency market. So look, this is a great resource, OEC World, and you can see where countries sell their exports to, and you can see what they're selling, and you can see what their key exports are. So for an example, if we look at Canada, crude petroleum makes up 12.7% of their exports. Refined petroleum makes up 1.96%. Petroleum gas makes up 1.86%. So 16.5% of their exports is coming from oil. Okay. So that's a large majority. That's the biggest export they're selling to the rest of the world. So you can clearly see, if I show you this chart over here, just how important the oil price is to the Canadian dollar. So this is important. All right. So if we look at the commodities and how it affects the Canadian dollar, we can have a look and we can understand why we have to look at commodity prices very, very closely to get an idea as to what's happening with the Canadian dollar. So look, here we go. We can look at the US dollar against the Canadian dollar. We can look at the price of oil. That's what this chart is. The blue line is the Brent crude price, and the orange line is the US dollar against the Canadian dollar. And look, what do you see? From 2001 to 2008, the oil price goes from $20 to $140. And the Canadian dollar strengthens against the US dollar over this next 7-year period. Why? Because the oil price is going up. So more money is coming into Canada to pay for their key export, and rest of world reserves of Canadian dollars are going lower because more money is coming into their country than more money is going out of their country. So there's less Canadian dollars in the rest of the world as reserves. Okay. And then look, as soon as the oil price slumps from $140 a barrel back down to 40, what happens? The US dollar strengthens against the Canadian dollar from $1 US buys basically 0.8 Canadian dollars to $1 US dollar buys 2.5%. Sorry, $1 Canadian dollar and 25 cents. So look, oil price drops, US dollar strengthens, and then oil price rises. No surprise, Canadian dollar strengthens. Oil prices kind of decline. No surprise, the US dollar strengthens. And then look, oil prices slump, US dollar strengthens, oil prices rise, Canadian dollar strengthens. You can clearly see the inverse correlation. So it's really important to understand how much the oil price affects the Canadian dollar. And then we can understand, if we go over here and have a look, just how much the crude oil price is being driven by a key economic indicator called manufacturing PMI in the US. And the reason this is so important is because manufacturing dictates whether the US is going to be growing or contracting. And because the US is the world's biggest economy, when the US is going through growth, it helps the rest of the world grow. So as the manufacturing data is below 50 and contracting, this causes the oil price to slump because we're expecting the US to go through a recession. As soon as the manufacturing data picks up, it starts to improve and goes above 50 again, indicating a contraction, the oil price takes off. And look, they literally move with each other going back to 2008. So we're looking here at a 14-year period where you can see the manufacturing data is telling you where the oil price is going. And at the moment in the US, the manufacturing data is above 50, coming lower from 60, but still strong. And the oil price is very bullish at this moment in time. And the Canadian dollar at the same time is what? Very bullish at the same time. So guys, you can start to see this picture painting about why the Canadian dollar strengthens on interest rates going up and the oil price. And at the moment, you've got interest rates going up and you've got the oil price very strong. So you've got two of the main features in the Canadian dollar's favor looking ahead for the currency to continue to strengthen in the markets. And because interest rates are not going up in Japan, it becomes even more favorable to sell the Canadian dollar, to sell the Japanese yen and buy the Canadian dollar. Because if you can understand overnight carry trade rates, you can understand how this drives the currency market. So look, let's go back over to our spreadsheet where I will, oops, did I close it? Okay, sorry, that was my fault. So now I want to show you how the overnight rates are really going to affect the currency market. So we looked at the government bonds. So we know that if government bonds are paying a higher rate in Canada over Japan, it's going to attract money into Canada relative to Japan, and it's going to take money out of Japan and directly into Canada, because a Japanese investor is not going to buy Japanese government bonds, are they? But if they look across the river and they see Canadian bonds paying 3%, then they're likely to sell their yen, buy Canadian dollars, and park their money in the Canadian bond market. And then we have the interest rate set by the central bank. And what the central bank interest rate does is it means that if Canada's rate goes to 2.75% by the end of the year, as I was showing you guys here, as it goes to 2.75% by the end of the year, this basically means that Canada's interest rate is paying a premium over Japan. And if Japan's rates stay at minus 0.1, which they will do unless Japan's inflation becomes a problem, which at the moment is not a problem, then what's going to happen is if I'm a trader in the currency markets and I look at this currency pair and I say, okay, if I sell the Japanese yen to buy the Canadian dollar, I don't pay any interest on the yen that I borrow, and I will get paid 2.75% interest if I hold that trade for 365 days. So I'm going to make 2.85% on that trade if I buy the currency pair, even if the exchange rate doesn't move. But then if the exchange rate does move, and let's say the Canadian dollar goes up by another 10%, add on that 2.75%, now I'm making nearly 13% return on my money. That's big funds. That's a lot of money if you're a hedge fund with billions of dollars under management. So you can start to see how that trade becomes very, very favorable, because if you're a hedge fund, then you've got a position, for an example, of 1,000 lots. I don't know how big the hedge fund is, but look, you could be making $8,000 a day in interest being deposited into your trading account because of the interest rate differential. But if I was to take the opposite trade and sell the Canadian dollar to buy the Japanese yen, that doesn't make any sense, because now I'm losing $8,000 a day every day I hold that trade open if I was to take a position worth 100 million currency pairs, if I'm looking at this exchange rate. So clearly, guys, you can see and you can really recognize why this currency pair is going up. Now, the reason I'm showing you this exchange rate is because other exchange rates are not going to be paying you that kind of premium, because the United States is raising rates. That's why the US dollar and the Canadian dollar, that's why the US dollar and Canadian dollar has been going up in the US dollar's favor since the beginning of the year. You can see Great British pound, Canadian dollar. Okay, you can see now that the pound's been getting weaker in recent months because of the recession fears and the oil price going up. Okay, so if we look at the beginning of the year, we've seen the pound getting weaker, but the central bank in the UK is raising rates at the same time. We've seen the Canadian dollar getting stronger against the euro as well, as we can clearly see here. But the European Central Bank is also expected to raise rates. So what we want to really do is just try to compare the Canadian dollar against countries that are not raising rates, so you can get the most optimal amount of profit in the currency pair. And that obviously is CAD JPY if you're looking at buying this currency pair. So guys, look, I hope that makes sense. This was just the main currency opportunity I wanted to show you in today's video. I hope that makes sense. Remember, you can come and join my trading team and passively invest with me. Or if you want to get your hands on my Forex video course, you can just ping me a message. But guys, make sure you're invested. And if you're not invested, come along and trade alongside me, and you can join and follow all these trades if you're interested. All right, guys. So thanks for joining. I hope this webinar was good for you and you understood something. And hopefully we can make some more profits in this currency pair as this trend continues, as it will do throughout 2022. All right, guys. All right, have a good day, and I'll speak to you later.